afternoon, everyone. Absolutely delighted to be back with you. We have Bob Diamond with us. I'm very excited about the next 25 minutes that we're going to spend talking to Bob about, well, just his foray into Africa and just generally being a bigwig in the banking industry, someone I've followed a lot throughout my career. Bob Diamond founded Atlas in 2013, and the whole aim of it was to create a pan-African bank at a time, as we all know, when international banks were reducing their global footprint. So we're going to find out what he thinks makes a successful foray into African banking, the challenges that there are that you are still facing and battling, and the expectations for banking in Africa over the coming decade. Bob, shall we start for anyone, and I'm sure there's no one in the room who doesn't know where you've come from or how you've got to this point, but just quickly recapping your experience in the banking industry and what led you to Africa.
Boy, there's a big question. Delighted to. So the short story is Morgan Stanley for 13 years, that brought me to London with Morgan Stanley. An opportunity to join Barclays when they didn't really have the international businesses of investment banking, Barclays Capital, asset management, which was Barclays Global Investors. But a funny thing happened while I was at Barclays, focused on building the international businesses. They had this incredible franchise in Africa. They had been there for 85 or 90 years, depending on the country. And in 2005, they acquired the majority position of ABSA. And as a board member, that was important. That was a very, very big acquisition. And the board asked me to spend some time in Africa working with the business to see if we could take the 13 separate operations, each with their own shareholding in the local market, each with their own kind of stovepiped operation, and begin to integrate some of the technology, some of the infrastructure, but most importantly, some of the ability to do business with clients who are doing business across border, helping them hedge out their agricultural risk or their currency risk. And it really led to a very, very high-performing and strong operation in Barclays Africa. And then another funny thing happened. I think not just me, but my wife and our 3 children fell in love with Africa. So I had an opportunity as a global banker. It was very unusual to have the kind of experience working in banking in Africa. But at the same time, all of us as a family just enjoyed being there. So it was a bit of a labor of love, but something that put me in a very interesting position. When I spent a year trying to retire after Barclays and failed miserably at trying to retire, the first thing we did in the firm I founded, Atlas Merchant Capital, was we identified an opportunity in Africa. But it was tricky, Naga. If we truly believed in the future of Africa, if we truly believed the demographics, urbanization, the ability to leapfrog, but if you looked very objectively, the financial services industry was somewhat simple. In most countries, not South Africa, but in most of the countries where we operate today in sub-Saharan Africa, banks are deposit-taking institutions, but they tend to invest those deposits in domestic treasury bills. And when those treasury bills yield 10, 11, 12, 13, 14%, you can imagine to take risk and to lend to consumers or to lend to small businesses, at what price are you going to do that? And so we saw a real opportunity with trade beginning to grow to create Atlas Mara. We did our first bank acquisition just about 3 years ago. Our timing was absolutely right at the cusp of the macro environment changing. Commodity prices dropping, currencies weakening, European banks pulling liquidity out of the market. So although it's been an incredibly challenging macro environment in the last 3 years, we have been able to acquire 9 banks in 7 countries. We just doubled up on our investment in Nigeria as recently as about a month ago. We think the opportunity today is probably better than ever. And our vision is very, very simple. It's the same today as it was when we started in 2014. We see an opportunity to invest in 10 to 15 countries in sub-Saharan Africa. In each of those, we want to be in a majority position of the bank that we own so that we can integrate across borders over time. In some of those countries, it's going to require more than one acquisition because we believe that if you're not operating in the top tier, in the top 3 to 5, you're probably not going to be relevant. And we see a phenomenal opportunity to leverage across those countries over time. It's still early days. We're still focused very much in country, but one integrated technology and operations platform that can be far more efficient. One markets and treasury business, so we can help small businesses fund their businesses across border, help farmers hedge out agricultural risk, create a capital markets platform so that people can, whether it's entrepreneurs and small businesses or medium-sized businesses, can raise capital in ways that's not just through the banks. And most importantly, to really drive digitization and technology across borders rather than just by country. So it's been a lot of work. It's been a lot of challenges. We hit the macro environment absolutely at the wrong time, but I think it's given us an opportunity to get more done than we ever would have been able to get done had it been kind of a rosy scenario.
So that's the journey so far and the vision, but let's pick apart some of the challenges that are being faced. You mentioned European banking capital being pulled. Now, that's at a time when opportunities, you would think if European banks are pulling this capital, the opportunities to invest in Africa would be much less, and it would be a much more intimidating place.
Yeah. And I think everyone here who's done business in Africa would say over the last 2 to 3 years, liquidity has been a big, big challenge. And, you know, it's not a view of Africa that's caused this capital to come out. It's really a reaction to Basel III and what happened post the crisis. So for the global banks, we saw Barclays exit Barclays Africa, or most of Barclays Africa. I think there's still a 15 to 20% shareholding. And the math was very compelling. Prior to the financial crisis, a big global bank like JP Morgan or Barclays would have a capital synergy by having multiple operations across Africa and around the world. But what happened post the crisis, because there's a tax on the global balance sheet in the UK, because the regulators require Barclays to hold 100% capital for 50% ownership, a variety of these issues have created that the 17% return on equity for Barclays Africa, when it gets to a global bank, is only 8%. If it were a regional bank, the 17% would be 17%.
So is your impression, because I can imagine you're still in touch with the big bods in the banking and the European banking system and in the US banking system as well, is your impression that there is no interest in Africa at the moment from the European banking sector?
I wouldn't say there's no interest, but I would say there's huge challenges. Let's take the European banks as an example. The smaller, not the global banks, but the smaller banks in France and Germany and across Europe, over 50% of the trade finance in Africa, over 50%, prior to the financial crisis came from those European banks. They had excess liquidity. With stricter capital rules, with Basel III, there's a need to pull that capital back to the home market in order to get return on equity above the cost of equity in the home market. And this has taken a few years, but it's really played itself out. So today, and this is what gets us so enthusiastic, today, the right model to own a bank in Africa is an African model. It's a Middle East or African model. It's a regional play. It's not the global banks who had a competitive advantage in capital now have a competitive disadvantage. And so being an African, multi-country African institution, we believe is the right model.
One of the words, or a couple of the words you used were integrated, digitization, integration amongst banks. I wonder how easy that is when there are banking systems in individual countries that are so separate and diverse. And then trying to, and as you said, you've bought banks, 17 countries, I think.
Nine banks in seven countries.
Seven countries. How do you connect those through your systems when all the systems are so different?
Well, you know, we faced two of these challenges head on just in the last year. In 2016, we acquired a second bank in Rwanda, and we integrated Development Bank of Rwanda, which was our first acquisition, and BPR, which was our second. And a credit to President Kagame and the team in Rwanda, who I know spoke earlier, they're very business friendly, and they were very constructive that we were going to have to integrate two institutions, and it went extremely well, but it was enormous work on the ground. We also acquired FBZ in Zambia in addition to our original acquisition of Bank ABC in Zambia. And I literally, when I leave here today, I'm flying to Zambia, and the team is, after a full year of integrating the two businesses and integrating the platform, we're doing a brand relaunch tomorrow and Friday in one integrated brand, one integrated platform. And again, it's a lot of work, but the benefit of now being one of the top tier banks in an important economy is worth it. When you think then about the bigger question is, how do you integrate the technology between Rwanda, Zambia, Nigeria? That will take another couple of years. We want to make each of our country banks strong on its own, on their own, before we try and integrate across border. But the board in our most recent meeting authorized a significant investment in expenditure in IT and operations across all of the countries we operate in. It's important for costs. It's important to stay in control. It's important for our customers and our clients. And if you are the most efficient with straight-through processing to clients, and you can bring on new products and new business more quickly, you're going to be a more efficient bank. I think one of the real critical components for banking across Africa is not just digital. It's not just fintech. It's really the core IT and operations that underlie the banks.
Well, we've got about 15 minutes left. I don't want to leave this opportunity for anyone who might have a question for Bob. There are some microphones around at the podiums. If anyone would like a question, just raise your hand if perhaps you do. Otherwise, I'll continue because I've got lots to ask Bob. You were talking about the brand relaunch, Bob. I'm just very interested to know, in the discussions you've had of late, as you're trying to, and is it fair to say, transform the banking industry in Africa, at least with your presence, and be in the top tier, what do customers need to see in terms of brand? What do you need to prove you are to show that you're worthy of being there?
So if we put ourselves in the customer's position, they don't just want to be able to have a deposit that's safe. They want to earn a return on that. But more importantly, I think the customers and clients want to believe that they're getting first-class service, first-class efficiency, and access to lending and lending products, access to credit in addition to just leaving deposits. I think the biggest challenge all of us have in banking in sub-Saharan Africa is each and every day earning our stripes with our customers and our clients, and proving that we're efficient and that we're providing the right products. I think of this especially with small businesses. When you can provide a small business, an agricultural firm, for example, with the opportunity to hedge risks and take term lending. If you're a farmer and you're only borrowing season to season to season, you're not necessarily investing in your business, and you're subject to ups and downs in interest rates and currencies. But if you can do term funding, it allows the agricultural sector to truly invest in their business for a 2, 3, 4, 5 year time frame. That means we need to be able to provide credit, we need to be able to provide term credit, and we need to be able to help them hedge out the currency and agricultural risks as well. Those aren't sophisticated from a banking point of view. I mean, these tools have been around forever. They are sophisticated in many African countries, but they're not sophisticated in terms of difficult to do. So we need to import some of the things that have already been proven in other developed and emerging economies into the banking system here.
Well, in terms of fintech, in terms of accessibility to banks and accessibility to technology and how people are changing, how is that different? Or how is your approach different compared to, I don't know, the typical European model? I live in the UK from London. I've always known a bank on the high street. I now use mobile phone banking. I very rarely go into one, and it's my laptop that I'll do my banking on. That's not the case in sub-Saharan Africa everywhere.
Absolutely, and I think for most of us, certainly my generation more than your generation, then the reliance on the bank and the branch in the traditional banking services, and all of us grew up with branches all around us, and we were spoiled for choice. Certainly in the UK, you know, every downtown area has branches of too many banks. That's not the case in sub-Saharan Africa, and I'm sure you've heard this number before, but over 80% of the people in sub-Saharan Africa don't live within a reasonable distance of a branch to say that they're going to do branch banking. Now that'll change over time. Urbanization is one of the trends that we're watching most closely and is real. But to reach many customers and clients, it's going to take a digital approach. And so we're focused on that. One of the principles upon which we run Atlas Mara is that as the chairman of the board, I take the direct report both of the head of banking and the head of digital. And I want them to work together, but I also want digital to feel that they can be creative and innovative and they don't have to respond just to what's convenient for our commercial bank. We want them to compete with each other a bit as well. So it's not really a management challenge because every one of us on the executive team understands the need to do this, but you really need to drive digital and traditional branch banking, and both of them are going to be with us for a very, very long time. I don't believe that there's a model of digital only. I think especially for small businesses, for farmers, for people moving to the city, they're going to want services where they're having discussions or doing things that are more complex and more complicated. But they also want the ease and efficiency of digital banking.
Which of the investments that you've made have progressed the quickest and why? Or have improved the quickest?
Which of the investments in Africa?
In Sub-Saharan Africa, yeah. Interesting
question. I've never thought of it that way. I would say our markets and treasury business. The third business that kind of reports directly to the board separate from the core banking is markets and treasury, which is the ability to work with our customers, particularly businesses, if you think about it, in hedging their currency risk. And if you have a dollar-based loan, you need to hedge that against the domestic currency in Zambia or Rwanda or any of these markets, and vice versa. But you also need to be able to hedge out some of the commodity risk and term and maturity risks. Equally, we have international investors, Fidelity, BlackRock, Wellington, some of the bigger investors around the world who are very interested in investing in Africa, but they don't always want equity. They might want to buy sovereign bonds, or they might want to buy local T-bills to get exposure to Africa. And we've been able to build a business under Mike Chrysalis, who had worked for me for many years in building that infrastructure that we talked about in Barclays Africa, so that we have both an onshore business working with each of the countries. So all of the treasuries report directly into one kind of head of risk. But that person can also stand off and be a client and a customer for the big international investors around the world. And if you think about it, the flows tend to offset each other. Right. So we're creating, particularly with the big global banks pulling away, not just from Africa, but in some ways with SIFI, GSIFI, from more emerging market type of risk, from more KYC issues, and from more risk-oriented businesses. The opportunity for us as we were a startup 3 years ago and began building Atlas Mara. Our opportunity to pick up market share has been, it's progressed far more quickly than I would have thought. It's our fastest growing business within the group.
What's the most frustrating thing about doing business and being a startup in Sub-Saharan Africa?
You know, I wouldn't say it's frustrating, but the reality is you roll up your sleeves and it's execution, execution, execution. We went into a very difficult macro environment with collapsing commodity prices, and I think of Nigeria as a good example. They were so dependent for dollars and for foreign currencies. But actually, over the last 2 to 3 years, I think Nigeria has a stronger economy than they did when oil prices were much higher. In the interim, there was absolutely nothing any one of us could do about the macro environment, not a thing. What we could do is we could out-execute the competition. And I think the cold, hard reality of Atlas Mara and any other business in Africa is execution, execution, execution. And you know, I get asked often about our client base because we raised equity. And in 2014, our first acquisition was made with $325 million in equity that was raised in our first capital raise. What surprised me and surprised a lot of people is that 90% of our investors in that initial IPO were US investors. And one of the reasons the US investors were willing to come into Africa is because we were operators. We were buying majority positions, and it wasn't a passive investment. It was a very, very active investment. So that comes back to the investors really have to make two decisions when they look at sub-Saharan Africa. One, I would say actually three decisions. The first decision is the macro environment. Do I believe in Africa rising? Is Africa somewhere where I should be putting an investment over the next 3, 5, 7, 10 years? They shouldn't do it if it's shorter than that. Then the second question is which sector? And then finally, which business? And when you get down to which business, it's who are the leaders, who's driving it. We just completed a $200 million permanent capital fundraising. It was fully underwritten by Fairfax Africa, and it was taken up primarily by Fairfax, but also over 70% of our existing shareholders took part in it as well. $200 million at this time is a big investment in Africa. And when we talked to Fairfax, they had gone through exactly that process, which is that they had made a decision a year ago that Africa was an opportunity. And they went to the Toronto Stock Exchange, they raised permanent capital, they formed Fairfax Africa, and they had the capital to invest. So when we began talking to them about investing in Atlas Mara, they had already made the decision that Africa was the right idea. Secondly, they had recognized that agriculture was a key sector. They recognized that energy was a key sector, and they recognized that financial services, particularly the provision of credit, was a key sector. So when we began our discussions, the first two of those questions were answered, yes on Africa and yes on financial services, which really came down to then, were we the right group for them to invest in? And I think that's where the hard work that we had all done in terms of providing execution on the ground was very important.
Explain briefly the differences and what you've learned in terms of dealing with governments, separate governments, when you're trying to have a holistic, or take a holistic approach to banking, and individual business sectors as well. I'm going to be very clear. We have found investing in Africa, we have found both governments and regulators to be very receptive. Receptive? Very receptive. And I don't think that's the perception in the world. And the reality is that we have permanent capital, so the regulators are very happy to have us investing in the financial services sector, even in a majority position. If we didn't have permanent equity, if it was a fund and we had to return the money, that would be different. But we come with permanent capital, a track record of success, and a commitment for the long run to Africa. So it's been real reception from governments and regulators. And you know, our first acquisition was an institution that had banking in 5 countries. About 50% of the equity was owned outside of Africa. And we acquired 100% of this institution. And it was approved by all 5 regulators within 5 months. I think if you look at the UK or the US today, or many of the European countries, I don't think you could get a bank acquisition approved in 5 months, never mind a bank across 5 countries. So one of the positive lessons we've learned is Africa is clearly open for business. Final question. What does the future hold for financial services in Africa? I do assume you brought your crystal ball with you today.
Yes. You have to have a little bit of a vision and a little bit of a crystal ball. I think the model will be regional. It will not be global. We talked about that a little bit. I wouldn't have given you that answer 5 years ago or 10 years ago. But I do think today that being an African-based bank brings capital synergies and more knowledge on the ground. I think it's going to be the model that wins. I think the model that wins will be multi-country. I think the dynamics in trade are compelling. Less than 20% of the trade in Africa is intra-Africa. That has to change. I had a meeting this morning with someone that was coming up from South Africa that was working with us on a project in IT, and they couldn't get into Dubai because they didn't have a visa. These things have to end. Now, Dubai is very open, but we still have these challenges across Africa of the mobility of people, the mobility of travel, highways across border, goods and services and labor being more mobile, the willingness to open borders for things that are good for the economy and good for jobs. So The banking, the winners will be African. The winners will be multiple country. The winners will have a strong, strong commitment and investment in IT and operations in both branch banking and digital. And I think that's certainly the direction we're heading in, so that's how we're driving the organization. I think we have the right vision in that way.
And you'll be there for quite some time.
This is a long-term investment. This is not for the faint-hearted.
Bob Diamond, everyone. Thank you so much.
Thank you. That's great.